It is time to talk about your money here on Good Morning Quad Cities at 11. It's not a new thing that interest rates for borrowing are high right now, but is it all bad news? Joining us to help us sort through this is Drue Kampmann, a certified financial planner from True Financial Partners in Bettendorf. Good morning, Drue. Thank you so much for joining us.
Good morning. Happy tax day.
Happy tax day to you. So this morning inflation has slowly been coming down, but many Americans still living paycheck to paycheck. Is there a silver lining?
Sure. We have seen a deceleration in inflation really from its peak, and it was reflected in the March CPI report, which is the Consumer Price Index, and it measures the change in the price of consumer goods and services year over year. So in March, it was up 5%. And if you look back at February, it was up 6%. So comparative from February of last year to this year was 6%. So we're seeing it fall, but the Federal Reserve continues to raise rates, which they have a tighter monetary policy. The objective here is to deteriorate demand, which deteriorate consumer spending. So higher interest rates will deteriorate people from spending money. But to answer your question, the silver lining in higher interest rates is it incentivizes savings. I mean, folks are paid more interest on their savings now than we have seen in a long time.
So that coming to deposit accounts. So what are some of those deposit accounts that you're seeing an increase in return for those who use them?
I mean, even in your simple savings accounts, you should be seeing higher interest rates. High yield savings accounts, we're seeing 4 to 5% rates of returns. We're seeing money markets pay 4 to 5% rates of return. And even going to CDs and U.S. Treasuries, which haven't been very attractive for really the last decade, are in that 4 to 5% range. In fact, yesterday, now rates are fluid, but yesterday I purchased a 6-month and a 6-month CD and a 6-month Treasury that paid over 5%. Now, shorter interest rates or shorter rates are more attractive than long-term rates right now. And it has to do with the inverted yield curve. So people are getting paid more money now.
Well, and of course, we also have retirement accounts, 401ks. A lot of people have been seeing a decrease in value over the last year or so. So what questions should we be asking or considering when we're trying to make smart investment choices?
I mean, if you have a longer timeline and you're younger, keep buying. I mean, keep investing, because today's asset prices are less than they were 12 to 18 months ago. So it's kind of like going shopping. You want to keep shopping when things are on sale. So if prices are lower now, keep buying. If you have a shorter time frame and you've stayed fully invested, I would say stay the course, because if you're more conservative, oftentimes you're going to be more exposed to or invested in tools like bonds. Well, since interest rates have gone up so much, bond prices have gone down, yet you've been paid more on it. The expectation is interest rates are going to go back down, so those bond prices will again reflect that in their pricing and go back up. So I would always say stay the course, but keep buying if you have a longer time frame.
Okay. Borrowing, of course, has gotten a lot more expensive, but we can't always afford to hold off getting a different vehicle, or maybe we have to move, we have to buy a different house. So are there ways that we can save some money through this?
Yeah, I mean, that's a tough question, because when there's a need, you've got to satisfy that need. And if you have to buy a new vehicle while prices are higher or interest rates are higher, we're certainly seeing that cost in purchasing and financing new cars. Buying a home, you've got a couple of different options. If you have the fear of maybe interest rates continuing to go up, you might want to go ahead and lock that in, specifically, let's say on a 30-year mortgage. But the other thing that I would throw out there is maybe even look at those adjustable rate mortgages. Because if you buy a 30-year at a higher rate today, you might be able to refinance at a lower rate down the road. But if you purchase an ARM or adjustable rate mortgage now, it'll be a more attractive and lower rate than what a fixed rate is. But then you may be able to refinance at a lower rate down the road too, or into a fixed rate lower down the road. So look at your options when you're financing, especially a big purchase like that in a new home.
All right. A lot of things that people need to consider. Drue Kampmann with True Financial Partners in Bettendorf. Thank you so much for joining us today. I'm sure you'll be able to get some rest now that tax day is here, and you'll be able to sleep well tonight.
Tonight is going to be a good night.
I believe it. Thanks, Drue.
Have a great day.
You too.